Hello, my name's Ethan. Make sure to check out my website, ethanwrenn.com. From there you can find links to all my various socials. We are currently live on YouTube, Twitch, and the front page of my website, so make sure to follow and subscribe if you'd like to get notified when we go live next. Also, I have a blog at ethanwrenn.com. Make sure to go check it out. It's quickly becoming one of my primary outlets. Today we're going to be looking at a video called The Pattern Day Trading Rule Explained, posted by the official TD Ameritrade account.
Means entering and exiting a position in a security within the same day. Day traders often use margin or money borrowed from a brokerage to increase leverage. While this can potentially increase profits, it can also lead to significant losses. To help protect novice investors from large losses, in 2001, the Financial Industry Regulatory Authority, or FINRA, created the Pattern Day Trader, or PDT rule. Under the rule, any margin account that executes 4 or more day trades within any rolling 5 business day period is flagged as a pattern day.
So, as they stated, FINRA originally put in what's called the Pattern Day Trading Rule to help novice or new investors. That's what they claim anyways. Honestly, they just wanted to put the retail trader at a massive disadvantage compared to their institutional peers who can trade as much as they want, right? But one thing to note with this is, I guess you could add a little bit of merit to it in saying what it does do is it prevents maybe the most degenerate of us from just mindlessly going in and out of trades all day and chasing losses when they really shouldn't on very risky intraday, fast-moving companies, you know. So, let's learn.
Day trader. Getting flagged isn't necessarily bad. It just puts the account under a little more scrutiny. Once your account is flagged as a day trading account, you're required to maintain a minimum of $25,000 of equity in that account. Flagged accounts below this equity level can face restrictions, so it's important to understand what counts as a day trade and what happens to your account once you're classified as a pattern day trader. So, what counts as a day trade? Under the PDT rule, a day trade is a complete entry and exit of a stock, options, or ETF position within a single trading day, sometimes called a round trip.
So what's interesting about this is, again, you definitely don't want to be in the position where you're getting flagged as a pattern day trader. The best way to avoid this is, well, there's actually a couple ways, and I think we're going to wait before we get into that. But as he just stated, for it to qualify as a day trade, it has to be an entry and an exit within the same trading day.
It applies to both long and short trades and includes pre- and post-market trading. The key to determining what counts as a day trade is matching buy and sell orders. For example, let's assume your account has no trades at the beginning of the day. Then you buy to open 100 shares, which means you purchase 100 shares to open a new position. Later, you add another 100 shares, and then you buy 100 more shares for a total of 300 shares. Later that day, you enter an order to sell to close those 300 shares. Despite there being 3 buy orders, there's only 1 exit order. This means there's only 1 pair of matching entry and exit orders, so it's only 1 day trade. The opposite is also true. If you buy to open 300 shares and sell them off in 3 separate orders throughout the day, it'd still only be 1 day trade because there's only 1 buy order. You also need to be careful mixing long and short trades. Imagine you buy to open 100 shares and follow it up with another buy to open for 100 shares. Then the stock turns bearish, so you sell your 200 shares. This counts as 1 day trade. Then you decide to short the same falling stock, so you sell to open 100 shares. Even though the second sell order is opening a new short position, it counts as a second day trade because it matches with one of the 2 earlier buy orders. However, there are some exceptions when buy and sell orders in the same day may not match and thus don't count as a day trade. This can happen if you're closing an existing position that was open during a previous trading day.
So this kind of gets into it, right? First off, I want to mention none of you guys should be having any problems abiding by the pattern day trading rules. You don't make money in this market quick. This game is not a get rich quick scheme as much as movies like The Wolf on Wall Street would like to paint it as. It's really not. You know, slow and steady wins the race. You want to be investing in the most high quality companies, the most blue chip companies. You know, sometimes the slow and boring stuff really is the stuff that wins at the end of the day. But let's say you did have a small account, and let's say you did like participating in the fun, very high risk stuff that you see on the today's top gainer in meters, whatever it is you might be looking at. There are some interesting different techniques you can employ in your investing to help you kind of get around the PDT rule, as I believe they're going to touch on one here. If you open a trade today and sell it tomorrow, even though you might have held it less than 24 hours, that does not count as a day trade, because the way that it's calculated is dependent on the trading session. It needs to be able to identify a buy and a sell in the same trading session that includes pre-market and after hours. But by the time the next day rolls around, that will no longer qualify as a day trade. How can you employ this information in your trading? Well, instead of looking for things that are going to run during market hours that you want to be day trading, maybe tune your investing mind a little bit to look for gaps. What do I mean by gaps? Well, let's say you're looking at company as they're stating here. We'll just use XYZ for an example. And you're expecting tomorrow this thing is going to gap up for whatever reason, news, indicators, whatever research you did, you feel like this stock is going to gap up at least 1% tomorrow. So what you might want to do is place a trade right before close, on like 15 minutes before the market close at like 3:45. And then tomorrow you wake up 9:30 in the morning, 2 minutes after market opens, you instantly sell that position to claim that 1% gap that you were expecting overnight. You probably held the stock for maybe 14 hours tops, but that did not count as a day trade. That is one way that you can try and work around the pattern day trading rule.
For example,
what's interesting is stuff like that is information you will never learn in your entire 4 years of getting a finance degree. But meanwhile, they'll have you sitting there calculating standard deviations with pen and paper, because as if calculators don't exist, as if like any firm would want you to be doing that by hand, like as if you're not providing more of a liability to the company by trying to do this stuff with pen and paper. Meanwhile, nobody's telling you at all about these actual circumstances that you're going to be faced with on a day-to-day basis that will actually better your in trading, or things that you might have to employ because of the limited amount of capital you have in your portfolio. Like, it just makes you think.
Well, let's say you already own 100 shares of a stock. When the market opens, you sell to close 100 shares. Later, you decide to buy to open 100 shares. You have one sell order and one buy order in the same day, but it doesn't count as a day trade because the first sell to close matched with the buy order from a previous day, so it cannot match with the buy order in the current day. However, existing positions don't mean you're free and clear. Let's say you started the day with 200 shares of stock. That morning, you place 2 buy orders for 100 shares each. Later that day, you sell 200 shares and then sell another 200 shares. This counts as 2 day trades because you added to the existing position before closing it, leaving you with 2 pairs of matching buy and sell orders in the same day. TDAmeritrade.com has alerts that can help you track your day trades, and the Thinkorswim platform counts.
Here's another thing to know, right? So let's say your account's less than $25,000, and you're subject to the pattern day trading rule. A lot of your brokerages, whether it be TD Ameritrade, as they're mentioning, or maybe Robinhood, for example, will keep track of these as they're mandated to by FINRA, publicly visible in your account. And I think Robinhood actually has an ability for you to lock it. So by putting this lock on, it physically will not let you make any more actions on your account that would result in a fourth day trade if you are already capped out on your 3-day trades in that 5-day period, etc. This can be a good and bad thing, right? Let's say because you're a degenerate who's trading way more than they should be on these very high risk, fast moving companies that you like to intraday trade. Let's say that's you. And 5 days has gone by and you've used up your 3 allotted day trades and you weren't even thinking about it because you're making so much money hand over fist, right? You're making so much money, you weren't even thinking about it. Well, here comes your 4th day trade, right? You see this great opportunity. You're like, oh, if I could just get in it for 5 minutes, I'm going to be a billionaire. So you go and put your life savings into this day trade. It starts moving, and then you feel like it's your time to sell. And then when you go to sell, your broker says, you can't sell this position because it would result in a 4th day trade in your pattern in your PDD thing. And then it says, oh, in order to close this trade, you're going to need to wait till tomorrow. And then you cry because you put your money into the fastest moving, most high risk, most no-name company that nobody's ever heard of. And because of that, who knows what the price is going to be tomorrow, right, guys? Like, it could move a lot in that time that you were not expecting to be in this fast-moving penny stock. So you need to be careful of that. You need to be cognizant of how many day trades you have left to be trading with, or else you could find yourself in a position like that where you're going to lose money. And on top of that, you expressed interest in closing the position to your brokerage. That's just not a position you want to be in. Let's say you are in that position. This is, again, more information that you just would only know by doing it, right? Let's say you are in that position. You're way over leveraged and you're locked on the amount of day trades you can do. I do think that Robinhood or Thinkorswim or some of these other brokerages that even offer the ability to lock you from going into that 4th day trade and getting flagged as a pattern day trader, I think you can also turn off that feature as well, which is something to keep in mind. You then have to think to yourself, is the money I'm going to lose on this singular day trade worth more than the consequences of being flagged as a day trader? So you have this option to turn off that lock and then execute the trade to neutralize your market exposure, which could be good. But then you got to deal with the consequences of the PDT rule, which theoretically could be a lot of things. They could prevent you from trading on that account for up to, I think, 6 months, something like that. So it's just something to keep in mind.
Them for you in the account info window. But it's important to understand what happens if you surpass the allowed number of day trades. An account that's flagged as a pattern day trading account and has less than $25,000 in equity will receive a day trade minimum equity call or equity maintenance call. You aren't required to immediately meet this call with funding. But if you place any more day trades while under the call, your account will be restricted to closing transactions only. This means you can close existing positions but can't open any new ones. The equity maintenance call ends when either you bring the account equity above $25,000 or the PDT flag is removed from the account. A pattern day trading flag can only be removed one time from your account. Remember that the $25,000 equity balance is the key. If you don't meet that requirement, you won't be allowed to day trade consistently. If you're concerned about being flagged as a pattern day trader, make sure you have a plan. Predetermine your entries and exits, and track when you place trades so you know when you've hit your limit. Understanding and following pattern day trading rules can help you avoid restrictions on your account.
The last and final bit of valuable information I can help you in regards to the pattern day trading rule. So there is one other way that you can kind of get around this rule if you had to. If your total assets are less than 25,000 and for some reason you don't like investing and you just like doing these tiny little intraday type trades You don't got to justify yourself to me. One thing that they glossed over in this video, and is again a little bit of real world information that you probably wouldn't get from a textbook, is the pattern day trading rule is on an account by account basis. So let's say you have $6,000 in assets in one account. That means you're allotted 3 day trades per 5-day period. Okay. You open a second account. You put half the assets in there. You now have 2 accounts, $3,000 each. You now have access to 6-day trades in a 5-day period. Sounds pretty good. You open a third account and split your assets across them. You now have 3 accounts with $2,000 in them each. You now have access to 9 day trades in a 5-day period, which, let's be honest, that if you need more than that, maybe you should start looking into different investing strategies. But I really do feel like that's valuable information for some who might be looking for information about the pattern day trading rule. So I think I provided multiple different ways that you can manage your accounts inside the scope of pattern day trading. And if you wanted my advice, I'd say take a good hard look at your approach to the markets and potentially look into longer term investments you can make that would actually result in passive income, right? Things that are a lot less micro, much more big picture, trading on those monthly time frames. And then if you're doing that, you're kind of avoiding all of this headache, right? And that's everything I have to say about the pattern day trading rule. TD Ameritrade does a great job kind of putting these videos together. There's a few more I have an interest in looking at that we're going to go over.